92,000 jobs vanished in the United States in a single month. Unemployment climbed to 4.4%. More than 160,000 positions disappeared after government revisions. And over $1.7 trillion of global trade is now tangled in a widening trade war driven by aggressive tariffs. Those numbers are not rumors. They are official economic signals emerging at the start of 2026. And together they raise a deeply uncomfortable question about the future direction of the United States economy. For years, policymakers insisted that the United States remained the strongest economic engine in the world. Yet recent labor reports tell a more complicated story. Job losses are no longer isolated to one industry. Construction firms are cutting workers. Manufacturing payrolls are shrinking. Restaurants and service businesses are scaling back staff as consumer spending weakens. At the same time, companies across the country are struggling with rising import costs caused by tariffs tied to an escalating global trade war. Today, I am going to reveal a secret so disturbing that almost no one in mainstream economic discussions is willing to say it out loud. Hidden behind the headlines about the trade war, tariffs, and slowing growth in the United States is a financial reality that could reshape the economic balance of North America. It is a development involving the United States, Canada, and trillions of dollars moving quietly through global markets. And when the full picture becomes clear, it may explain why some investors believe the real shock of this trade war has not even begun yet. In the first quarter of 2026, a series of economic indicators began revealing a far deeper level of stress inside the United States economy than most public discussions acknowledged. New business formations slowed sharply, while bankruptcy filings accelerated at a pace not seen since the aftermath of the global pandemic. According to commercial court filings compiled by restructuring analysts, more than 28,000 American businesses filed for bankruptcy protection within the first 3 months of the year, a surge of nearly 34% compared with the same period 2 years earlier. Small and medium-sized enterprises appeared particularly vulnerable. These companies employ nearly 44% of the United States workforce, yet many operate with extremely thin financial margins. When the cost of imported materials rises because of tariffs connected to the ongoing trade war, even a small increase in expenses can trigger a chain reaction. Accounting data from regional business associations indicated that input costs for several manufacturing supply chains increased between 18 and 26% over the past 2 years. For thousands of firms, that increase erased nearly all operating profit. The impact was not limited to factories. Retail data revealed that consumer purchasing power was weakening as well. Household credit card balances across the United States climbed to $1,130 billion, the highest level ever recorded. At the same time, delinquency rates on those credit cards rose above 7.2%, signaling that millions of consumers were beginning to struggle with basic monthly payments. When consumer debt reaches such levels, economists often interpret it as an early warning signal that household finances are approaching a breaking point. Financial markets also began flashing unusual warning signals. Several major freight and shipping indexes, which track the movement of goods across the economy, fell by more than 21% within 6 months. Historically, such declines occur when manufacturing orders slow and companies begin reducing inventory purchases. In other words, businesses appear to be preparing for weaker demand ahead. Meanwhile, companies attempting to navigate the trade war environment are facing increasingly complex supply chain decisions. Importers paying tariffs on machinery, electronics, and industrial inputs have reported cost increases reaching 30% or more in some product categories. Those higher expenses do not disappear. They ripple through production lines, logistics networks, and consumer prices. Yet behind these visible economic pressures lies a development that almost no mainstream discussion has fully confronted. Quietly, and largely outside public debate, capital flows inside North America are beginning to shift in ways that could redefine how the trade war between the United States and its partners affects the long-term economic position of Canada. And the next revelation may be the most disturbing detail yet, Because hidden in the movement of global investment capital is a pattern that very few people have publicly connected to the rising tariffs now shaping the United States economy. While headlines inside the United States focused on layoffs, tariffs, and slowing sectors, another transformation was unfolding quietly inside global financial markets. It did not appear suddenly. Instead, it emerged gradually through investment data, sovereign fund movements, and corporate expansion decisions. But by the beginning of 2026, the numbers began pointing to something that many analysts had previously considered unlikely: a measurable shift of global capital away from parts of the United States and toward alternative economic environments, with Canada increasingly appearing on that list. Foreign direct investment flows provide one of the clearest signals of where the world's largest institutions believe future economic stability will exist. According to international investment monitoring groups, global investors allocated more than $210 billion into Canadian assets and industrial projects during the previous year. That level of capital inflow represented the largest single-year investment expansion in Canada since the period before the financial crisis of 2007. By contrast, several large investment banks reported a slowdown in new long-term manufacturing investment commitments inside certain sectors of the United States. In particular, industries that rely heavily on international supply chains began reconsidering where future facilities should be located. When tariffs raise the cost of importing specialized components, companies must calculate whether manufacturing inside the United States still produces competitive pricing in global markets. For multinational corporations operating across multiple continents, these decisions involve billions of dollars. A large manufacturing plant producing electronics, automotive components, or industrial machinery can cost anywhere between $4 billion and $12 billion to build. Once constructed, those facilities typically operate for decades. That means companies must evaluate not only current tariff conditions, but also the possibility that trade policies could change repeatedly over time. This is where the ongoing trade war environment begins, influencing long-term strategic planning. When businesses face uncertainty about future tariffs, they often search for locations where trade access remains stable and predictable. In North America, Canada has increasingly presented itself as one of those alternatives. Canada maintains trade agreements covering more than 50 countries and economic regions, including the Comprehensive Economic and Trade Agreement with the European Union and the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. Together, these agreements give Canadian exporters preferential access to markets representing more than 1.5 billion consumers worldwide. For multinational firms deciding where to place production facilities, that kind of access can become a powerful incentive. The result has been a gradual but noticeable redirection of certain investment decisions. Provincial economic agencies in Ontario, Alberta, and British Columbia reported that more than 300 international companies either expanded or relocated key operations in Canada between 2024 and early 2026. These projects ranged from semiconductor supply chains and battery manufacturing to advanced logistics centers designed to serve global distribution networks. Energy investment has also followed a similar pattern. Canada's resource sector attracted more than $80 billion in new capital commitments across energy infrastructure, natural gas processing, and mineral extraction during the same period. Global demand for critical minerals such as nickel, cobalt, and lithium has grown rapidly as electric vehicle production expands worldwide. Canada holds some of the largest reserves of these materials among advanced economies, and stable trade relationships allow mining companies to export them to multiple international partners without the uncertainty created by tariff escalation. Meanwhile, several financial indicators inside the United States began reflecting cautious sentiment among institutional investors. Data from equity fund monitoring groups showed that American stock market funds experienced net withdrawals exceeding $48 billion during a single 6-week period, as portfolio managers diversified holdings across international markets. While this movement represented only a small percentage of total global capital, it signaled a change in behavior among some of the largest asset managers responsible for pension funds and sovereign wealth portfolios. Bond markets offered another subtle clue. For decades, United States Treasury bonds have been considered the ultimate safe asset in global finance. Yet during several debt auctions in late 2025, demand from foreign buyers declined noticeably compared with historical averages. When demand weakens, governments must offer higher yields to attract investors. Even small increases in borrowing costs can translate into tens of billions of dollars in additional interest payments each year when national debt levels exceed $36 trillion. For financial analysts, these developments do not necessarily indicate immediate economic collapse. The United States still commands enormous financial strength and remains one of the most powerful economic systems in the world. However, markets operate on expectations about the future rather than on past reputation. When investors detect increasing uncertainty created by tariffs, trade disputes, or geopolitical spending pressures, they begin spreading capital across multiple regions rather than concentrating it in a single economy. This diversification effect is precisely what the ongoing trade war environment has started producing. Companies that once built nearly every major North American facility inside the United States are now dividing projects across several countries. Canada has become one of the most attractive destinations within that new equation because it offers access to the American market while simultaneously maintaining broader international trade relationships. But the most surprising development in this shifting economic landscape is not the investment movement itself. What truly startled several economic research groups was the speed at which some of these capital flows began accelerating once tariffs reached certain thresholds in key industries. And buried inside those financial movements is a pattern so unusual that a handful of analysts have begun asking a question that could redefine the entire debate about the trade war between the United States and its partners. Because the next discovery suggests that the real economic consequences of rising tariffs may not be visible in employment statistics or trade reports yet. They may be hidden inside something far larger that few policymakers have openly discussed: a structural financial imbalance quietly forming beneath the surface of the United States economy. While investors were watching the movement of capital and corporations were adjusting supply chains around tariffs and the widening trade war, another financial pressure was quietly intensifying inside the United States. This pressure did not appear in daily headlines about layoffs or manufacturing. Instead, it emerged from the structure of government finance itself, where debt, interest payments, and fiscal obligations were rising at a speed that alarmed several economic monitoring institutions. By the beginning of 2026, the national debt of the United States had surpassed $36 trillion. That number alone is difficult to comprehend, but the more significant figure for economists is the annual cost of servicing that debt. Interest payments on government borrowing approached $980 billion per year, meaning the United States was spending nearly $1 trillion annually simply to cover interest obligations on past borrowing. To put that number into perspective, the interest burden alone had become larger than the total annual budgets of most government departments combined. Analysts from fiscal policy groups warn that if borrowing continued at the same pace and interest rates remained elevated, interest payments could exceed $1.2 trillion per year within the next few years. The connection between this debt pressure and the ongoing trade war may not seem obvious at first glance. However, economists point to a chain reaction triggered by tariffs and slower economic growth. When tariffs increase the cost of imports, businesses often reduce investment and hiring. Slower hiring reduces wage growth and consumer spending. Lower consumer spending weakens tax revenues flowing into federal and state governments. When revenues weaken while spending continues rising, governments must borrow more money to cover the gap. Federal deficit projections illustrated this problem clearly. Budget reports indicated that the annual deficit of the United States had expanded to approximately $2.1 trillion in a single fiscal year, one of the largest peacetime deficits ever recorded. Financing that gap requires issuing enormous quantities of treasury bonds into global financial markets. Yet demand for those bonds has shown signs of becoming more unpredictable. Several major international holders of United States government debt began gradually adjusting their portfolios, Foreign central banks and sovereign wealth funds that once accumulated treasury securities automatically are now diversifying their holdings into multiple currencies and asset classes. In practical terms, this means the United States must sometimes offer higher yields to attract the same level of investment. Even a small increase in borrowing costs can produce massive financial consequences. If the average interest rate on federal debt rises by just 1 percentage point, the additional annual cost can exceed $360 billion, according to debt market calculations. Meanwhile, the broader economy continues feeling the effects of tariffs imposed during the escalating trade war. American companies importing industrial components, electronics, machinery, and specialized materials are paying significantly higher prices at the border. In some categories, tariffs range from 10% to 35%, depending on the product classification. Those costs cascade through production networks. A manufacturer importing $30 million worth of parts may suddenly face an additional $9 million in tariffs. That increase forces executives to choose between raising prices, reducing payroll, or delaying expansion plans. When thousands of companies across the country confront the same decision at the same time, the cumulative economic effect becomes substantial. At the consumer level, these pressures are beginning to appear in subtle ways. Price tracking groups report that several categories of imported consumer goods have experienced cumulative price increases ranging between 12% and 20% over the past 2 years. Household budgets already stretched by housing costs and energy expenses are absorbing those increases gradually, but the long-term effect is a steady reduction in purchasing power. For a country where consumer spending drives nearly 70% of economic activity, even small declines in purchasing power can ripple across retail, transportation, hospitality, and manufacturing sectors simultaneously. Yet perhaps the most unsettling development is not the debt itself, nor the tariffs, nor even the trade war shaping global commerce. What truly concerns a growing group of economists is how these factors are beginning to interact with each other. Tariffs increase business costs. Higher costs slow hiring and investment. Slower growth weakens tax revenues. Lower revenues increase deficits. Larger deficits require more borrowing. Higher borrowing raises interest payments. Rising interest payments consume a growing share of government spending. This cycle can gradually tighten financial flexibility for any country, even one as economically powerful as the United States. At the same time, Canada is navigating the global economic environment with a very different fiscal structure. Canadian public debt remains significantly smaller relative to the size of its economy, and government spending has focused heavily on infrastructure investment, energy development, and expanding international trade partnerships rather than financing large deficits tied to geopolitical spending commitments. International investors are noticing this contrast. Institutional portfolio managers responsible for trillions of dollars are increasingly evaluating not only growth potential, but also fiscal sustainability when deciding where to allocate capital. And that evaluation is beginning to produce an uncomfortable realization for some analysts. Because if the financial trajectory of the United States continues moving in its current direction, while the trade war environment intensifies, tariffs and global supply chains reorganize, the economic shift already beginning inside North America could accelerate much faster than most policymakers currently expect. But there is one final piece of the puzzle that almost no mainstream economic discussion has fully addressed yet. It involves a strategic global response to the trade war, one that could reshape international trade routes and investment alliances in ways that may surprise even experienced market observers. And the evidence behind this hidden shift may be the most revealing development of all. While domestic debates inside the United States focused on tariffs, job losses, and rising debt pressure, the rest of the world was not standing still. Governments, multinational corporations, and global investors were quietly redesigning trade networks that had been built over decades. And the numbers emerging from international commerce statistics reveal that the ongoing trade war has already begun triggering one of the most significant trade realignments since the end of the 20th century. Between 2023 and early 2026, countries outside the United States signed more than 48 new bilateral and regional trade agreements covering an estimated $3.4 trillion in annual commerce. These agreements were not minor technical adjustments. Many of them created entirely new supply corridors linking Europe, Asia, Latin America, and several emerging industrial economies. What made this development remarkable is that a large share of these agreements were structured specifically to reduce reliance on trade routes that depend heavily on the United States market. For multinational corporations managing global production networks, these agreements provide new strategic options. A company manufacturing electronics in Asia can now export finished goods to European markets under preferential tariff conditions through agreements that completely bypass American trade channels. Agricultural exporters in South America can reach Asian markets through newly negotiated shipping corridors that reduce dependence on traditional North American intermediaries. At the center of this evolving network stands Canada, whose geographic position and diplomatic trade strategy have placed it in a unique position during the current trade war. Over the past several years, Canada has expanded trade frameworks covering more than 50 nations and economic regions, granting Canadian exporters preferential access to markets representing approximately 1.5 billion consumers worldwide. As global companies examine this landscape, Canada increasingly appears not merely as a neighboring economy, but as a strategic gateway into multiple global markets simultaneously. For businesses concerned about tariffs imposed by the United States during the trade war, operating within Canada offers a way to maintain access to North American consumers while also benefiting from broader international trade agreements. Export data reflects this advantage. Canadian merchandise exports reached approximately $760 billion annually, representing one of the fastest export growth periods in the country's modern economic history. Energy products, agricultural commodities, advanced manufacturing equipment, and critical minerals all contributed to that expansion. One sector experiencing particularly rapid growth involves materials essential for the global energy transition. Canada possesses large reserves of nickel, cobalt, lithium, and rare earth elements used in electric vehicle batteries and advanced electronics. As demand for these materials increases worldwide, mining companies and technology manufacturers are investing billions of dollars in Canadian extraction and processing projects. Several of these projects are directly connected to multinational companies that once concentrated their North American investment primarily in the United States. But the uncertainty surrounding tariffs and trade policies has encouraged corporations to diversify their geographic footprint. Logistics networks illustrate how rapidly these shifts are occurring. Container traffic through several major Canadian ports increased by nearly 27% within 3 years, reflecting rising international shipments moving through Canadian infrastructure toward both American and overseas markets. Rail freight, connecting Canadian industrial regions to Pacific shipping terminals, has also expanded significantly as exporters redirect supply chains. Tourism data provides another indicator of changing global perceptions. International visitor arrivals to Canada increased by roughly 26% within a 2-year period, while foreign travel to the United States declined by approximately 18% during the same timeframe. Although tourism represents only one component of economic activity, it reflects broader global sentiment regarding political stability, diplomatic relationships, and international cooperation. Financial markets are also adapting to this new environment. Global investment banks have begun describing Canada as one of the most politically stable advanced economies in the Western Hemisphere. Demand for Canadian government bonds reached record levels during several quarters of 2025 and early 2026, pushing borrowing costs lower and allowing Canadian infrastructure projects to be financed at highly favorable rates. Meanwhile, the United States continues to play an enormous role in global commerce. Its consumer market remains the largest in the world, and its technology sector continues driving innovation across multiple industries. Yet the current trade war environment is forcing global partners to reconsider how heavily they rely on the United States as the central hub of international trade. This shift does not mean that American economic influence will disappear, but it does suggest that the structure of global trade may be becoming more distributed, with multiple economic centers emerging instead of a single dominant hub. And this brings us to the most sensitive question raised by the entire sequence of events surrounding tariffs, trade disputes, and shifting investment flows. If the United States continues expanding tariffs as part of the ongoing trade war strategy, and if international partners continue building alternative trade alliances that bypass American markets, could the long-term effect gradually reduce the central role that the United States has played in the global economic system for nearly 80 years? That possibility remains controversial, and many economists strongly disagree about how far the current trends might go. But hidden inside the data is one final development that could determine whether this trade war ultimately strengthens American industry or accelerates a deeper transformation in global economic leadership. After examining the layoffs, the rising tariffs, the growing debt pressure, and the shifting trade alliances, a deeper strategic question begins to emerge. What if the current trade war is not only about short-term economic disruption, but about a far larger restructuring of the global industrial system? For decades, the United States built its economic power on a model of globalization. American companies designed products, coordinated finance, and managed supply chains that stretched across continents. Raw materials might originate in Africa, components could be manufactured in Asia, final assembly might occur in Mexico, and the finished product would ultimately be sold to consumers in the United States or Europe. That system created enormous efficiency and lowered prices for decades. However, that same system also produced a new vulnerability. By the early 2020 decade, more than 60% of critical industrial inputs used by American manufacturers were sourced from foreign suppliers. In sectors such as advanced electronics, pharmaceutical ingredients, and rare earth processing, the United States depended heavily on overseas production networks. When geopolitical tensions increased and the global trade war intensified, policymakers in Washington began reassessing whether such dependence represented a long-term strategic risk. Tariffs became one of the tools used to encourage companies to relocate supply chains closer to the United States. By raising the cost of importing certain goods, policymakers hoped that domestic manufacturing would eventually expand. But the transition from a globalized supply system to a more localized one is extremely complex. Building new industrial capacity requires enormous capital investment, skilled labor, and time. Constructing a modern semiconductor facility can cost more than $20 billion, and advanced battery manufacturing plants often require investments exceeding $10 billion before production even begins. During the early phases of such a transition, economic disruption is almost unavoidable. Supply chains must be rebuilt, companies must renegotiate contracts, workers must be retrained. Prices may temporarily rise while industries adjust to new production structures. Some economists therefore argue that the current trade war and the tariffs imposed by the United States represent an attempt to force a painful but necessary economic transformation. From this perspective, the goal is not immediate economic comfort, but long-term industrial resilience. Yet critics strongly disagree with that interpretation. They argue that tariffs imposed during the trade war may be creating uncertainty that discourages investment rather than encouraging it. If corporations cannot predict future trade policies, they may postpone major manufacturing projects entirely or shift them toward countries where trade relationships remain stable. This is where Canada enters the equation again. Because Canada maintains extensive trade agreements with multiple global partners while also sharing deep economic integration with the United States, some multinational firms see Canada as a strategic compromise. Companies can build facilities in Canada, maintain access to American consumers through North American trade frameworks, and still export products to international markets under favorable tariff conditions. That dynamic creates a complicated competitive landscape. The United States remains the largest economy in the world, but Canada is positioning itself as a stable gateway into the broader global trading system during a period when tariffs and the trade war are forcing companies to rethink traditional supply chains. Whether this transformation ultimately strengthens the United States or redistributes economic influence across several regions remains uncertain. The outcome will depend on how quickly industries adapt, how trade policies evolve, and how global investors respond to the new economic landscape. But there is one final conclusion that cannot be ignored. The tariffs shaping the current trade war are no longer just policy tools. They are catalysts, triggering structural decisions by corporations, governments, and investors that could reshape the economic map of North America for decades. And the most surprising consequence of all may be how this transformation changes the relationship between the United States and Canada in ways that very few people predicted only a few years ago. The evidence emerging across employment data, corporate investment decisions, government finances, and global trade alliances points to one clear reality. The ongoing trade war and the tariffs imposed during this economic confrontation are reshaping how businesses and investors evaluate the future of the United States economy. The United States still holds extraordinary economic power. It remains the world's largest consumer market, a global leader in innovation, and the center of many of the most advanced industries on Earth. Yet, the current period of rising tariffs and geopolitical competition is introducing new pressures that are forcing both domestic companies and international partners to rethink long-established economic relationships. At the same time, Canada is demonstrating how stability, diversified trade agreements, and predictable economic policy can attract investment during periods of global uncertainty. The contrast between the two neighboring economies is becoming one of the most closely watched developments in international economic analysis. Whether the current trade war ultimately strengthens American industry or creates new economic centers across North America remains one of the most important unanswered questions facing policymakers today. And the world is watching closely, because the outcome will influence global trade, investment flows, and economic leadership for decades to come. If you want more deep global economic analysis about the United States, Canada, tariffs, and the evolving trade war shaping the world economy, subscribe and follow for the next report. Thanks for watching.